In international business circles, India's tax administration has earned a rather unflattering reputation. Tax in India requires specialist attention. India's tax regime is broad, multi-layered, and administered with considerable aggression by authorities. The label of tax terrorism, however uncomfortable, reflects a genuine reality that many foreign investors and their advisors have encountered. At the same time, the system is navigable for businesses that plan carefully, adopt conservative positions, maintain excellent documentation, and engage qualified specialist advisors from the outset. Hello and welcome back to the Veyrah Law Series. Today's episode deals with a subject that in our experience causes more anxiety among foreign investors than almost any other aspect of doing business in India: the Indian tax regime. In international business circles, India's tax administration has earned a rather unflattering reputation. It has been labeled tax terrorism in the financial press and among investor communities. That term is strong, and it reflects genuine and documented frustrations. With the aggressive posture of India's tax authorities, the frequency of demands and litigation, and the significant uncertainty around India's tax positions. We will address all of that honestly in this episode, but we will also try to give you a clear, structured picture of how the system actually works, because understanding the architecture is the first step to navigating it sensibly. One important caveat before we begin: tax law in India changes with some frequency during the budget presented each year in the Parliament. The tax aspects discussed in this episode broadly reflects the position as applicable for financial year 2026-27. Please verify current rates and applicable provisions before making any decisions. My name is Ajay Joseph. I'm a partner at Veyrah Law. We are a law firm based in Mumbai, India. You can find more information about me and Veyrah Law on our website. The link is in the description below. Before we get started, a quick reminder: these videos are not advertisements or solicitations. They are only for sharing information. Nothing shared here should be treated as legal advice. Please consult your own qualified tax advisors before making any decisions. Lastly, please read the disclaimers carefully. With that done, let us get into today's topic. Let us start with the basics: how the Indian tax system is structured. India's tax system operates across three levels of government: central, state, and in some limited respects, municipal. For the purposes of this episode, we are focusing on the taxes that are most material for a foreign business operating in India. Municipal levies, professional tax, and similar ancillary charges exist, but they are relatively minor and vary significantly by location. At the broadest level, Indian taxes fall into two categories: direct taxes and indirect taxes. Direct taxes are levied on income and gains. They fall directly on the person or entity earning the income. In India, direct taxes are administered centrally by the Central Board of Direct Taxes, the CBDT, under the Ministry of Finance. The primary legislation that governed direct taxation was the Income Tax Act 1961, now replaced by the Income Tax Act 2025. Next, we have indirect taxes. These are levied on transactions, on the sale of goods, provision of service, or import of goods. They are collected by the business conducting the transactions and passed through to the government. The primary indirect tax in India today is the Goods and Services Tax, or GST, introduced in 2017. Customs duty and certain other levies sit outside the GST framework. The administration of these two categories is split. Direct taxes go to the central government and are administered by the CBDT. Indirect taxes under GST are administered jointly by the Central Board of Indirect Taxes and Customs, the CBIC, and by the state GST authorities, depending on the nature of the transaction. This dual administration across both the Income Tax Act and the GST framework, and across both central and state authorities, is one of the reasons why Indian tax compliance is more complex and resource intensive than in many comparable markets. Let us look at the broad category of taxes that a business would have to manage in India. The tabular column bifurcates the important direct and indirect taxes that impact a business operating in India. Starting with direct taxes. First off, we have corporate income tax. The principal direct tax for a business operating in India is corporate income tax. As the name suggests, it is a tax on income and subject to different limits and thresholds based on turnover. For domestic companies, Indian incorporated entities, the rates vary from 22% of net taxable income and 30%. These base rates are subject to additional surcharge and cess. For foreign companies, including branch offices and project offices of foreign entities operating in India, the base tax rate is 40%, again subject to applicable surcharge and cess. This significantly higher rate is one of the structural reasons why most foreign investors prefer to operate through an Indian incorporated subsidiary rather than a branch wherever the business model allows. Next is dividend taxation. Dividends paid by an Indian company to its shareholders, whether Indian or foreign, are taxed in the hands of the recipient as ordinary income at the applicable tax rate. For a foreign company receiving dividends from its Indian subsidiary, a withholding tax applies. The rate of withholding on dividends paid to foreign shareholders is generally 20% under domestic law, subject to reduction under an applicable double taxation avoidance agreement, a DTAA between India and the country of the recipient. India has a broad network of DTAAs, over 90 bilateral treaties. The applicable treaty rate on dividends varies. Understanding and correctly applying the relevant DTAA is an important part of tax-efficient structuring for any foreign investor. Then we have capital gains. Capital gains tax in India distinguishes between long-term and short-term gains based on the holding period of the asset. The applicable rates and thresholds have been revised in recent years. The table shows the applicable rates for listed and unlisted shares by duration and applicable rate for financial year 26-27. Capital gains tax is an area of particular importance for foreign strategic and financial investors, since exit from an Indian investment, whether by way of share sale, buyback, or reduction of capital, will almost invariably trigger a capital gains event. Treaty planning and ensuring that the structure is substantively compliant with India's anti-avoidance rules is critical. Next, we have TDS, or tax deducted at source. India's TDS regime is extensive, and it is one of the aspects of Indian tax compliance that often surprises foreign businesses encountering it for the first time. Any person making specified payments, salaries, professional fees, interest, royalties, dividends, and many others, is required to deduct tax at source at the prescribed rate before making the payment and deposit the deducted amount with the government. For payments made to non-residents, including foreign parent companies, foreign service providers, and foreign lenders, TDS applies at rates that can range from 10% to 30%, depending on the nature of the payment, subject to applicable DTAA relief. Failure to deduct or remit TDS correctly exposes the payer to interest, penalties, and disallowance of the expenditure as a deduction. In practical terms, the tax cost falls on the payer rather than the recipient. Managing TDS compliance correctly, particularly for cross-border payments, requires careful attention and specialist advice. It is a frequent area of tax scrutiny and dispute for foreign businesses operating in India. Before we move to discuss indirect taxes, it would be relevant to touch upon the concept of general anti-avoidance rules, or better called GAR, under the direct tax regime. India's general anti-avoidance rules, GAR, were introduced with effect from April 2017. Under GAR, any arrangement entered into primarily for the purpose of obtaining a tax benefit and which lacks genuine commercial substance can be declared an impermissible avoidance arrangement and disregarded for tax purposes. Treaty benefits will not be available to structures that lack genuine commercial substance. Structures designed primarily to achieve tax efficiency without genuine business rationale are a material risk. With direct taxes covered, let us turn to indirect taxes, which present their own set of complexities. Goods and Services Tax, GST. The Goods and Services Tax, introduced in 2017, represented one of the most significant tax reforms in India's independent history. It replaced a fragmented system of central and state indirect taxes with a unified, destination-based consumption tax. GST has undoubtedly simplified the indirect tax landscape relative to what preceded it. The elimination of the cascading effect of taxes, where tax was paid on tax at each stage of the supply chain, has been a genuine improvement. The input tax credit mechanism, which allows businesses to set off GST paid on business inputs against GST collected on business sales, is broadly functional and significantly reduces the effective tax cost of compliant businesses. That said, GST remains a complex regime in practice, and foreign businesses should not underestimate this complexity. The rate structure was recently consolidated into 3 slabs from the earlier 5 slabs. 5%, 18%, and 40% is what exists today. In addition, certain goods attract a cess on top of falling within the highest rate bracket, primarily luxury and sin goods such as premium cars and tobacco. Classification disputes also arise often in GST. Determining which rate applies to a particular good or service have been a significant source of litigation under GST, mirroring the disputes that characterized the old indirect tax regime. As some would observe, the framework has changed, but many of the underlying complexities have not. Registration and compliance under GST requires registration in each state where a business has a taxable presence. In practice, this means most states where goods are stored, services are provided from, or where a fixed establishment exists, each state registration is a separate compliance obligation with its own monthly and annual returns. For a business operating across multiple states in India, the compliance burden can be substantial. Penalties for non-filing, delayed filings, and interest on late payment of tax can accumulate quickly and become material if not managed proactively. Then there's the three-way split in the GST regime: CGST, SGST, and IGST. Reflects the constitutional division of GST revenue between the central government and the states. CGST and SGST apply to interstate transactions, sharing the revenue equally. IGST applies to interstate transactions, with the revenue subsequently allocated between the central government and the destination state. For a business with operations and customers across multiple states, tracking and correctly applying this distinction adds another layer of compliance complexity. Next in line, we have customs duty. Customs duty applies to the import of goods into India and in certain cases to exports. Import duties in India, which include basic customs duty and IGST component and various cesses, can be material, particularly in sectors such as electronics, consumer goods, and industrial machinery. Understanding the applicable tariff classification and duty structure is an important part of planning for any manufacturing or import-dependent business. Then there are items outside GST and certain other levies that we need to discuss. Not all goods and transactions are within the GST framework. Certain items of significant commercial importance, including petroleum products, alcoholic beverages for human consumption, and electricity, remain outside GST and continue to attract the pre-GST regime of state-level taxes, central excise, and other levies. For businesses in the energy, beverages, or transportation sectors, this is a material compliance consideration. Stamp duty levied by state governments on the execution of instruments such as share transfer deeds, loan agreements, and property transactions, also sits outside the GST framework. Stamp duty can be significant in value, particularly in M&A and real estate transactions. Rates vary substantially across states and by the nature of the instrument. The picture that emerges is one of a broad, multi-layered tax system with significant compliance obligations and real enforcement risk. Let us turn to what businesses should do about it. Tax is one domain where we would always say, engage a specialist before you begin, not after a problem arises. The following are the principles we consistently share with clients. First, engage a qualified tax advisor before you start operations. This is non-negotiable. India's tax laws are complex. The penalties for non-compliance are severe, and the personal exposure of directors and management to tax liability is real, as we discussed in our earlier episode on director liability. Do not rely on generalist advice for tax structuring. Engage a qualified chartered accountant with specific expertise in international and corporate taxation in India, working in conjunction with your corporate legal advisors. Get this right from day one. Restructuring around tax problems after the fact is invariably more expensive and more disruptive than planning correctly at the outset. Second, avoid aggressive tax structures. Substance must match form. The Tiger Global judgment is the most recent and authoritative reaffirmation of a principle that has been central to Indian tax jurisprudence for many years. India's tax authorities look through structures and assess tax based on economic substance. Merely routing investments to an intermediary jurisdiction, Mauritius, Singapore, the Netherlands, does not by itself secure treaty benefits or avoid Indian tax if the structure lacks genuine commercial substance. If you're using an intermediary holding entity, as we recommend for risk management purposes, ensure that the entity has a genuine functional presence, a properly constituted board that takes real decisions, meetings that are properly minuted, separate bank accounts, and a genuine business rationale beyond tax efficiency alone. The structure must be able to withstand scrutiny. Third, be conservative on GST classification. Classification disputes, determining the applicable GST rate for a particular good or service, are a frequent source of indirect tax litigation in India. The temptation for business teams and sometimes for their advisors is to adopt an aggressive classification position that results in a lower rate and a short-term cost saving. This is a risk that is rarely worth taking. If there is any ambiguity about the applicable classification, obtain a sound legal opinion before adopting a position. And where the law provides a mechanism for obtaining a formal ruling from the GST authorities, consider using it. A favorable advance ruling provides certainty and protection. An aggressive classification that is subsequently challenged by the authorities can result in demands for the differential tax, interest, and substantial penalties, and potentially years of litigation. Fourth, do not underestimate the tax department's appetite for litigation. India's tax authorities, both the Income Tax Department under the CBDT and the GST authorities under the CBIC, have a well-documented tendency to litigate aggressively even in cases where the legal position is relatively clear. This is partly a function of institutional incentives. Tax officers face pressure to generate revenue, and raising a demand, even one that is ultimately unsuccessful, serves that purpose in the short term. The result is a system where the probability of receiving a tax demand, an audit notice, or a scrutiny assessment at some point during the life of an Indian business is very high. This is not a reason to avoid India, but it is a reason to maintain impeccable documentation, adopt conservative positions on gray areas, and ensure that your advisors are prepared to defend your positions efficiently and professionally. Fifth, take search and seizure powers seriously. India's tax authorities, both the Income Tax Department and the GST authorities, have broad powers of search and seizure. The Income Tax Department can conduct search and seizure actions without prior notice, including seizing books of account, documents, and digital records. The GST authorities have similar inspection and seizure powers. These actions can be significantly disruptive to business operations, both practically and reputationally. The best protection against them is a clean compliance record, well-organized documentation, and no aggressive positions that a tax officer might view as an invitation to investigate. The simple question to ask yourself is this: is the money being saved through an aggressive tax position worth the risk of a search and disruption that follows? In most cases, the honest answer is no. Sixth, manage tedious compliance with particular care. As discussed, tedious compliance, particularly for cross-border payments, is an area of frequent dispute. Ensure that your finance team and advisors have a clear documented process for identifying tedious applicable payments, applying the correct rate, deducting and remitting on time, and filing the required returns. For payments to foreign parties, assess the applicability of DTAA relief carefully and maintain the documentation required to support reduced withholding, including tax residency certificates from the recipient. Errors in this area are expensive. The disallowance of the underlying expenditure as a deduction compounds the cost of the tedious shortfall itself. Let us bring this together with a closing perspective. To summarize, India's tax regime is broad, multi-layered, and administered with considerable aggression by authorities. They have both the statutory powers and the institutional incentives to pursue every gray area vigorously. The label of tax terrorism, however uncomfortable, reflects a genuine reality that many foreign investors and their advisors have encountered. At the same time, the system is navigable for businesses that plan carefully, adopt conservative positions, maintain excellent documentation, and engage qualified specialist advisors from the outset. India has a functioning tax network, a well-developed body of case law, and an appellate and judicial system that, despite its delays, does ultimately provide resolution. Businesses that operate transparently and within the spirit of the law have a reasonable basis for confidence that they will be treated fairly over time. The directional trend is also worth noting. India's tax administration has been progressively digitizing. The income tax portal and the GST network have both improved significantly in recent years, reducing the scope for discretionary interference and making compliance more process-driven. But for now, the baseline reality remains. Tax in India requires specialist attention, conservative planning, and a clear-eyed acceptance that the tax authorities will scrutinize your affairs closely. Factor that into your operational budget and your compliance infrastructure from day one. As the saying goes, in this world, nothing is certain except death and taxes. And in India, taxes come with a particular level of complexity and vigor. So plan accordingly. With that, we come to an end to this video. If you found this video on the overview of Indian taxation useful, please do share it with others who may benefit. Thank you for watching and see you in the next episode.